All right, it's the ultimate financial heavyweight matchup. In one corner, we have the stock market, dynamic, highly accessible, and historically an absolute massive generator of wealth. And in the other corner, real estate, tangible, steadfast, and a cornerstone of legacy building for generations. Today, we're settling the debate once and for all. Stocks versus real estate. Where should your money actually go?
If you're staring at your savings account right now, wondering exactly where to deploy your hard-earned cash, well, you're definitely not alone. In fact, Americans currently have trillions of dollars just sitting in cash accounts, losing purchasing power to inflation simply because they don't know where to put it. It's completely normal to feel torn here. Deciding between these two proven wealth builders is arguably one of the toughest financial choices you'll ever make. It's a true crossroads, and the direction you choose is going to heavily define not just your financial future, but your day-to-day lifestyle.
So, here's the roadmap for today's explainer. We'll start with the ultimate wealth debate. Then make the case for stocks, follow that up with the case for real estate, and finally, figure out exactly where your money belongs.
Let's dive into part 1, the ultimate wealth debate, setting the baseline.
There's a fundamental separation we need to establish right away between paper assets and hard assets. When you buy a stock, you are buying a fractional ownership piece of a real breathing business, right? But it's a paper asset. It lives on a screen. You can't physically touch it. On the flip side, real estate is a hard asset. Brick, mortar, land, a roof over someone's head. You can physically walk inside of it. Now, both of these vehicles can build you an absolute fortune, but they require entirely different mindsets to manage.
Moving right along to part 2, the case for stocks, the paper asset route.
Okay, let's dive into the pros of the stock market, because there's a lot of exciting stuff here. First off, stocks are highly liquid. You want to buy or sell? It's just a simple tap on your smartphone from literally anywhere on the globe. If you need your cash on a Tuesday, you can generally have it sitting in your bank by Thursday. They also offer a remarkably low barrier to entry. You don't need a massive $50,000 down payment to start. Actually, you can begin building a portfolio today with just $5 using fractional shares. Then there's the management side. It is entirely passive. You don't have to plunge a toilet at midnight or interview prospective tenants. And finally, you get the sheer magic of compounding interest. To put it into perspective, an average historical return of about 10% on the S&P 500 can essentially double your money in 7 years, and you didn't have to lift a finger.
And that brings us to one of the absolute best perks of being a shareholder: dividends. You can think of a dividend as a regular profit distribution paid directly to you. Successful companies take a portion of their massive quarterly profits and literally just hand it back to their shareholders. This serves as a fantastic source of truly passive income. You don't have to sell a single share to see that cash flow into your checking account. You just hold the stock and the cash flows right in. It's really that simple.
But let's slow down for a second, because the stock market is absolutely not a guaranteed smooth ride. The biggest con? Market volatility. The stock market can be a stomach-churning roller coaster. Prices swing wildly up and down based on global news, interest rate hikes, or just general investor panic. And honestly, this volatility breeds our second major con, which is emotional investing. When you see your life savings drop 20% in a single week, human instinct screams at you to panic sell. But doing that permanently locks in your losses. It takes absolute iron discipline to hold through those storms. Finally, you have no physical control. You can't just march into the boardroom of a massive tech company and tell the CEO how to run their business. You're completely along for the ride, for better or worse.
All right, part 3, the case for real estate. Let's step into the other side of the ring.
The pros of real estate offer a completely different kind of financial power. First and foremost, this is a tangible asset. Humans are just inherently wired to value things they can touch, and real estate provides a really deep psychological sense of security. Plus, historically, we see steady property appreciation over the long term, acting as an incredible hedge against inflation. But here's where it gets really good. The real magic of real estate happens when you pair that long-term appreciation with leverage and immediate rental income. With leverage, you can use, say, a 20% down payment to control 100% of a massive asset. And then someone else, your tenant, goes to work every single day to pay you rent every single month. They're essentially covering the cost of that asset while you reap the long-term rewards of its growing value.
To really understand how this works, we have to look closely at equity. Equity is simply the exact difference between what your property is worth on the open market today and what you still owe the bank on your mortgage. This is exactly how wealth is stored, locked in, and built within physical real estate. Every single time your tenant pays that monthly rent, a portion goes straight to paying down your mortgage loan. So as the loan shrinks and the property value simultaneously grows, your true wealth is rapidly expanding.
However, being a landlord is incredibly demanding. We've got to acknowledge the harsh realities here. Real estate is highly illiquid.
You can't sell a duplex with a quick tap on a screen. Offloading a property takes months, it requires real estate agents, home inspections, and massive closing costs. There is also a very high barrier to entry. You need a significant down payment, excellent credit, and solid cash reserves just to get a seat at the table. Then comes the grinding reality of active management and maintenance costs. A broken HVAC system in the dead of summer? Yeah, that's an $8,000 emergency, and your tenant is calling you at 2 a.m. on a holiday to fix it immediately. Make no mistake, real estate demands your time, your energy, and a lot of your capital.
Which brings us to part 4, where your money belongs. Let's get to the final verdict.
When we view these options side by side, the major trade-offs become incredibly clear. Let's look at liquidity. Stocks give you instant access to your cash, while real estate basically traps your money in the walls. In terms of management, stocks are beautifully passive. Real estate, it's inherently active. It's practically a second job. And looking at the barrier to entry, you can buy stocks with the spare change in your pocket, whereas real estate requires serious, heavy capital up front to even step up to the plate.
So the most crucial point to take away from this entire explainer is this. There is no universal right answer here. There's only the right answer for you. Are you the hands-off investor? Do you prioritize your free time, want extreme liquidity to remain flexible, and have the emotional discipline to just ignore the stock market's wild daily swings? Or are you the hands-on operator? Do you want physical control? Place immense value on tangible assets you can actually see? And are you willing to roll up your sleeves to actively manage your wealth and deal with all the inevitable headaches?
Ultimately, the absolute worst thing you can do is leave your cash sitting completely idle, slowly losing its purchasing power to inflation. Both paper assets and hard assets have successfully minted millionaires for centuries. The real variable in this wealth equation isn't the asset class itself, it's you. It's your free time, your available capital, and how you genuinely want to live your day-to-day life while your money grows. So as you look closely at your own lifestyle and your personal risk tolerance, which investor are you?